Good evening, everybody. Some of you joining tonight, I'm aware, know me. We've got some existing clients on the webinar tonight. For those who haven't met me before, welcome, and hopefully this will be informative to outline what's been happening with the McCloud Judgment on the NHS Pension, some of the impacts that it will have on you, whether you've already retired, whether you're about to retire, or whether you're just saving into your NHS pension and want to know what your options will be now and at retirement. As it notes on this homepage, feel free to type your questions in the Q&A box. I'll go through the webinar. Any questions about specific areas, pop them in, and then at the end I'll look through the Q&A and try and answer some of your questions. So, just a bit of background about our company and myself. We're specialist advisors to medical professionals, part of the FTA group, and a lot of you will know what they do in dentistry and the medical fields in terms of the range of services. We've worked with FTA for sort of 15, 20 years, advising their clients on a range of financial planning. We're independent advisors, whole of market advisors, so we're not tied to any providers, any strategies, any menus of advice, and we've listed at the bottom some services that we provide. So investments and savings and pensions and retirement planning, including NHS, other workplace pensions, but also private pensions, where we do a lot of work in as well. Tax planning advice, and really this is where we help a lot of FTA clients who haven't perhaps dealt with us before, those who are approaching a time when they have their children grown up, they have a bit more money in the bank, their business is going well, they may even be planning an exit or actually looking at marketing their practice with FTA. And they speak to us in terms of the tax planning on the last few years before retirement, but into retirement as well. There's lots of various things that you can do at those stages, especially compared to when you're just sort of saving away merrily. Insurances, some of you may have dealt with our protection department, in particular, Christine, who advise on personal protection, business protection as well. And we also have Sue in the company, who is a will writer and will and estate planning advisor. So, you know, anybody looking ahead will want to have that conversation with Sue, or has already had that conversation. And also as business owners, you want to be looking at this sort of thing as well to make sure the business and the family are protected. So on to the agenda for the webinar today. We're going to run through in sort of order, giving a background of what's happened, who's affected, what's been announced, and there's been lots of updates this year. I'll take you through the timeline later, but you know, as recently as a couple of weeks ago, the NHS have issued sort of guidance to employers on how this affects employees, which is obviously everybody, all the members, and we're not going to have every single answer for you today because the NHS is still working on some of the information. This has been thrown upon them. You'll see this in a moment. If you haven't read much about it already, you'll see the potential conundrum they have now to work all this out. But they have announced some things, so we have some clarity about how it's going to work, and we'll relay that to you depending on the situation you're in. You might need to do things soon, you might have a bit of time. There's things you can do to plan ahead, of course, with the NHS pension, and we can help with that, but of course in other areas of financial planning as well. You know, it's the NHS pension isn't the be all and end all of financial planning. We'll touch on a few of those areas today, albeit this webinar is to be focused around the McCloud Judgment and the NHS pension itself. And then finally, some key takeaways, how we can help you assess your NHS pension options and what you can do next. So without much further ado, let's start looking at the NHS pensions. What you have, what they are, how they work. Now, most of you on the webinar today, or watching the webinar, if you're watching it after, will have multiple schemes. That's kind of a lot of the time why you'd want to look at this McCloud Judgment. So a lot of the clients that we work with have the 95 scheme. Some have the 2008, some of our younger clients, but a lot will have the 95 scheme. Now, the 95 scheme and the 2008 scheme are final salary schemes. They have earlier retirement ages than the new scheme. We'll cover the 2015 scheme in a moment because that's what's called all of this McCloud Judgment issues or upheavals in terms of how that's implemented and what's happened. But the old legacy schemes are the old gold standard NHS pensions. They've got normal retirement age 60 and 65. In terms of how your pension accrues, the information in that table there of 1.4% of total uprated earnings for the 95 scheme and 1.87% for the 2008 scheme, that's specific to practitioners. So nearly all of the clients that we work with in dentistry would be under that remit. It is different if you're an officer, classed as an officer in the NHS pension scheme. So, an employee within a hospital or something like that. And in those examples, it actually is 1/80th of your pensionable pay times the years of service in a nutshell for the 95 scheme, and 1/60th of your pensionable pay times the years of service for the 2008 scheme. So the other slight differences between those two schemes, you can see in the box that actually the 95 scheme has an automatic tax-free lump sum that's accrued. It actually has a lower accrual rate. You can see 1.4 versus 1.87, but crucially, it's got an earlier retirement age, normal retirement age, and it's got a tax-free lump sum added on, and that's 3 times the pension that you've accrued. With the 2008 scheme, there's no automatic lump sum. Same with the 2015 scheme, but you can give up some pension for lump sum if you want to, and we'll talk about that in a moment. So let's look at the new scheme, the 2015 scheme. If you were between certain ages, and we'll go through that in a later slide, you may not have been moved into the 2015 scheme yet, but a lot of the members in the NHS scheme who are still active members will have been moved in. Whether that was in 2015 or if they were transition members slightly later. This operates in a completely different way in some aspect, but at the end of the day, it's still a defined benefit scheme. You still have a guaranteed pension at retirement that's payable for the rest of your life. It just accrues in a different way. So first of all, the main difference is that the normal retirement age is linked to the state pension age. This was the big change in terms of pension reform. And this is across all public sector schemes, by the way, not just the NHS pension, the new pension reform for these new schemes in 2015. The way it accrues is through career average. It's called CARE, Career Average Reevaluated Earnings. So all that means, as it notes in the box, is that you take 1/54th every year of your pensionable earnings, that's called the build-up rate. You times it by inflation, effectively, plus 1.5%. And then every year that logs onto your pension accrual. So you've got this accrued pension, and then you start afresh from the next year and add on to it every year. Now, this is much more in line with how pensions, defined benefit pensions, are working outside of the public sector. So it is understandable that they would bring in this type of saving. It's arguably fairer because you're averaging out, you're adding on for every year that you work a sort of pension pot that adds up. It's always inflation linked, CPI plus 1.5. It's actually going up ahead of inflation to make sure that you don't lose out to inflation. So that's the main change. And this was brought in after consultation from April 2015. But as I say, some members didn't join it straight away because they were within a certain period of time before retirement. I note at the bottom of this slide that you should be downloading your total reward statement and consulting an advisor or a specialist to find out what you have. It will have an impact on not just your retirement plans with accruing the NHS pension, but also what else you should do. If there's allowances there, if you're not up to your allowances for pensions, there's big merit in actually adding to a private pension, and we'll talk about that later. You used to get a statement every year in the post, and they stopped doing that a few years ago. They went into this online system called the Total Reward Statement System. If you Google it, NHS Total Reward Statement, then you'll be able to sign up and access your online system. And I would urge everybody, if you haven't done so already, to get access to that, because you will need it to actually keep up to date with what you have accrued in your pension. They're not going to be sending out automatic pension statements in the post anymore. You can always request one, but if anyone's dealt with the NHS before, they know that they have to wait 3 months for nearly anything to come back from them. So it's advisable that you sign up and do that. Now, a lot of you, as I say, will have two of these pensions, 95 and 2015. We'll talk about how this works with the McCloud Judgment and then what happens after that. But going forward, it's likely you'll have an old scheme, a 95 or a 2008, sat there, inflation linked. So don't worry, it's not going to go anywhere. It's actually not going to go down in terms of value. It's going to be inflation linked. And then the 2015 scheme will be the new one that accrues from April 2022. Now, a few options that you'll have on these pensions, not just for now when you're looking at which one do you want to choose in this remedy period, which is what we'll go through for the McCloud Judgment, but on retirement, for the 2008 scheme and 2015 scheme, you don't get an automatic lump sum, tax-free, but you can give up some pension for a tax-free lump sum. You normally give up £1 of annual pension income for an extra £12 tax-free lump sum. This works out, if you're a higher rate taxpayer, pretty much the same. And you can, look at how you use that extra lump sum and pay off debts or invest the money. And will that be better than getting the long-term pension income? Very difficult to forecast because you don't know how long you're going to live. That's really this pension's benefit. If you live to your 105, you want the extra income. If you pass away age 75, you want the extra lump sum. So it is difficult, and we always go by average life expectancy when we do our forecasts, but it is an option that's there. You can give up some pension from your 2015 scheme or 2008 to get lump sum. You can also give up extra pension in your 95 scheme to enhance your tax-free lump sum. We do this for a lot of clients. So when you get there, you have that option. You also have the option to take the pension early. You can look at those normal retirement ages, and probably some of you are thinking, oh, the 2015 scheme is age 67, it may be, or 68 for me, when I can actually take it. You can take it early. Now, when you take any of the schemes early, they have an actuarial reduction. There's different rates depending on which scheme it is, but it works out around 5% a year less for every year you take early. So that maybe doesn't seem that bad. And typically, if you're still working, in some capacity in the NHS, it's potentially not worth doing. But if you're retired, it may be worth doing. It may be worth taking early. It depends on your situation. It's not clear cut, and every client will have a different situation on that. But you can take the pension early if you're thinking about retiring before the dates that are given there. Another option, which is very important to note, is for those clients who may be transitioning into the 2015 scheme and they think, well, what if I want to retire age 60? I aim to retire age 60. I want to take my 95 scheme. Do I have to take the other scheme as well? You should think of your two schemes, if you're going to have these two schemes running, as separate. They are separate in terms of their operation, and they can be taken separately. So you can take, for example, retire and take your 95 scheme, age 60, no actuarial reduction, and you can defer taking your 2015 scheme for a few years to either not have an actuarial reduction, age 67 or 68, or take it a little bit early and have less of a reduction. Again, the best option will depend on your situation. It will be a bit of personal preference, but there will possibly be a right route for you depending on your tax situation, your earnings, and that sort of thing. Now, another thing to note for dentists, which we help a lot of clients with, is you don't always have to have stopped working in the NHS to take your pension. If you're working past age 60 and you have a massive or a sizable 1995 pension, 30, 40,000 a year, even though you're still working, it may be worth considering taking that pension and doing what's called retire and return. There are rules in terms of what you can do when you return. You can only do certain hours for the first period of time, but in certain instances, we've actually advised clients that they do this because it makes sense. This is for clients who have very small contributions going in every year, because once you take your pension, you can't then be an active member of the pension in the same capacity and keep adding in. So you're basically giving up the new money that you're adding into the pension to get this 1995 scheme early. If you're 61, 62 still working, this may be worth doing, but it's likely if you have large pension contributions going in, it's probably worth hanging on. So again, case specific, and we can help look at that for you. Just moving on to the next slide, let's talk about what's happened with the McCloud Judgment. So as I mentioned, they brought in the 2015 scheme from April 2015. That was not deemed to be unlawful. You know, it's happened in lots of public sector schemes. The state pension's gone up in terms of the minimum age. People are working longer. It is fair enough, you know, that they introduce this new scheme. What they have done that has now been contested and subsequently ruled to be unlawful is they said, well, we're going to bring this pension in from 2015's pension scheme in from 2015, but if you were within 10 years of normal retirement age for your particular scheme, let's say you're in the 95, age 60, within 10 years to age 60 in 2012, then you don't have to join the new scheme. So that sounded at the time fair enough. Okay, it's been brought in, it's going to be a high retirement age. I'm near enough, so I'm going to not join it. I'm just going to carry on with my legacy scheme. It has a lower annual pension accrual amount, so I'm getting slightly less put in every year, but actually I can take it earlier without penalty. So that seemed sensible at the time. I don't think myself or many clients or other experts really balked at this too much when it was announced, but obviously the implementation has been reviewed a bit more. Crucially, what's happened as well is people who were between 10 and 13 and a half years from retirement at April 2012 were called transition members. So what they said was, well, we're not going to put you into the 2015 scheme straight away. We're going to put you in at a later date before April 2022, which was when everyone was going to be in it. So what's happened subsequently is this has been deemed to be unlawful, age discrimination. And in December 2018, the Court of Appeal found that the transitional protections, specifically for firefighters and judicial schemes, were unlawful, age discrimination, and therefore they had to remedy this with all members and give all members the same type of options. It's going to affect 3 million members estimated in the UK. Public sector, again, this isn't just NHS, this is teachers' pensions, firefighters, judicial, all sorts of public sector pensions across the country. So they had to review and work out how to make this fair for all members. So it took a little while. You can see there, 2018 December, it was ruled unlawful. July 2019, the government accepts that the judgment applies not just to the firefighter and judicial schemes, but across all public service schemes, which, you know, they're similar structures, so that was to be expected. And then it took until there was a few updates in between where they were working things out, going to appeal, and eventually in February this year, they decided how they were going to implement the remedy for this, and they chose the deferred choice underpin. Now, what that means is, as it sounds, you've got a deferred choice. You basically make a decision when you take your pension. Now, I'll talk about how it's going to work for those years, April 2015 to April 2022, which is this transition period, in a moment. But effectively, after that, everyone's in the 2015 scheme as was originally planned. And then when you come to take your pension, you'll have the options to decide whether to have between 2015 and 2022 all your benefits in the old legacy scheme, the old 95 or 2008, or you can choose to be in the 2015 scheme for that period. And it will depend on your situation, depend on what you do in the NHS and your pensionable earnings and when you're retiring. It will be different for everybody, but they'll give you the information to make that decision. So that all sounds okay. It's going to cost the NHS a huge amount of money to sort this out and to sort of remedy it, and everyone's going to be able to pick which option was best for them. But what this causes sort of slight uncertainties for is people who've already taken their pension or who are about to take their pension. So we'll talk about that in a moment. Just to clarify the dates, if you're not 100% sure in terms of whether you were classed as fully protected or under this tapered protection, which was deemed to be unlawful because that's still going on until they actually implement these changes. It was actually for 1995 scheme members, anyone born before the 1st of April 1962 had the full protection, so they never went into the new 2015 scheme. And transitional, anyone born between the 1st of April 1962 and 1st of October 1965 had this transitional protection. So you might have just seen yourself, if you're in that bracket, going into the new scheme on a statement and thinking, okay, I'm in there now. So let's move on to who's affected, because some of the people on the webinar today, I'm sure, are wondering whether it affects them. I've put together a table here where you can sort of cross-reference and work out what your options are and whether it affects you. So were you an active member of the scheme on or before the 31st of March 2012 and also on or after the 1st of April 2015? If yes, then is your scheme retirement age on or before the 1st of April 2022, or have you retired before that date? So let's look at those examples now. So let's look at people who've retired already between 2015 and now, or who are about to retire before the 1st of April 2022. You'll receive a choice between your legacy scheme and reform pension scheme for the period. Now, you won't have anything from the NHS yet. They'll probably be looking to deal with you first, because you have to make a decision before people who are retiring in 10 years, of course. But it's going to take them a while, as we'll mention later, to get these figures together. When they are together, we can help decide, but you'll have a choice between whether you are part of the 95 scheme or the 2015 scheme in between. It's likely, and I'll mention this later, that if you've retired age 60, you'd rather have been all in the 1995 scheme, for example, or if you've retired age 65 in the 2008 scheme, if you were in that scheme, because otherwise, if you're in the 2015 scheme, you'd have had that actuarial reduction I spoke about, but it will be member specific. So you need to have a look at the figures with a financial professional just to make sure that you make the right decision, because it could make the difference of a fair few £1,000s. If you're not retired already, or you're not due to retire before the 1st of April 2022, then that deferred choice underpin kicks in. So you'll have a choice to make when you retire. So the only other people in between, in the bottom left of that table, is people who were deferred members. So they kind of were in the NHS scheme, then they left, and they've come back in. This will affect some people, but it will be more rare than most people here today, I'm sure. So if you are deferred for less than 5 years and you've come back into the scheme, you'll also have a choice to make through either the deferred choice underpin or a choice sort of soon if you've taken your benefits. So what has been announced and how's it going to work? What they're going to do is they're going to put all active member schemes back in. They're going to move all active members into the 2015 scheme from April 2022. This was always proposed, so this is going to carry on as it was. You know, they said the 2015 scheme is coming in for everybody, including the transitional members, from April 2022. Everybody who's affected by that box previously will be automatically returned to the legacy schemes, the 95 or the 2008, for their benefits accrued between 2015 and 2022, and if you retired earlier up to that date. Now, this is going to be an enormous administrative task for the NHS scheme, for all the other public sector schemes. They need time to implement this, and they've been given the date of October 2023 to implement these returns to the legacy schemes in terms of the data, the raw data, to actually do that, which will take a lot of effort, to give you the figures, because what that will do, as I've mentioned here, is affect potentially your annual allowances and lifetime pension allowances if you've taken your pension. So there will perhaps be impacts retrospectively on your tax planning, your pension allowances, the planning you're doing with your financial advisors. I've done with some of my clients where we've carefully assessed their annual allowances and suddenly they're moved into a different scheme. How will that affect them? There might be some assessment and some things to do there. So once we have these figures ready, we can help our clients. In the meantime, there are things we can do for people who are already retired or about to retire in terms of assessing potentially which would have been the best option. But until you have all the figures, which they've got the date of October 2023 to kind of sort everything out by, we won't have all the data to give you that choice. And as I say, there's a chance there'll be people with data before October 2023. But I'll be honest, I don't hold out a huge amount of hope for them being ahead of that schedule because of the enormous task there is, and just previous with the NHS pension. It's a very good pension, but administratively, in terms of time taken to do things, there is even a chance they run past that date, I would imagine. So we have to sit tight in many cases to actually make that decision. Now, it mentions at the bottom, I've already said there, that you'll be given the choice at retirement between the schemes. So you'll have a choice to be legacy scheme or the new scheme. So you have all the choices available with all the data available. You can chat with me or your financial advisor, go through everything in detail, work it all out. Where does that leave me? Depends on your exact situation, which choice you should take. And then you can decide. And those who've already decided, you'll get a choice to retrospectively change. And again, it will depend on your situation. So we'll deal with that, obviously, when we have the data, and you'll have to sit tight. So you may be concerned about how it's affected your tax, and rest assured you will be given time when you have the data to actually remedy this and go through with your accountant, with your financial advisor, and work out how it affects you and what to do. So looking at the annual allowance, let's have a little think about how that's going to affect you. Let's say you were put into the 2015 scheme in April. You weren't one of the transitional members, but you've actually had all those benefits from the last 7 years moved back into your legacy scheme. Now, as we showed in the NHS pension information at the start, the pensions accrue in a different way. You know, for dental practitioners, you've got 1.4% of pensionable earnings over your life, revalued by that revaluation figure. And for the new care scheme, it's actually 1/54 of your earnings. So it is very different. Now, what it typically is the 2015 scheme actually accrues at a higher rate than the 95 scheme or the 2008 scheme in terms of your annual allowance usage. Not always. It will depend exactly on your situation, and if you're a practitioner, an officer, and your earnings in between, and your specific data on your pension and how it's built up. But generally, it's going to mean that a lot of the members will actually use less annual allowance in those periods. So you might have seen you were using 10,000 annual allowance every year between 2015 and 2022, and then suddenly that drops to 8,000, for example. So it's likely for a lot of members, there's not going to suddenly be a tax charge that you weren't sure of, but that will not apply to every single person. So we do have to look at this carefully. I've mentioned that there, many could see a reduction. If you have overpaid, if you've gone over your annual allowance and you've paid an annual allowance tax charge because your pension's accruing at a high rate, or if you've used scheme pays to pay that tax charge, you may get a refund. And this will apply to people who've taken their pension as well, of course. It's not just people who are carrying on. You'll get all of this remedied after. But it may be better than you think in terms of the annual allowance tax charge for a lot of members. If there's additional costs, the government at the minute have agreed to meet the costs as part of this remedy. So let's say that you've planned and been part of the 2015 scheme and actually moving back into the legacy scheme, you're going to have a higher annual allowance usage because of your specific situation. Then if there's an additional tax charge, then that's announced to be met. It's a bit like at the moment or last tax year, they agreed to pay the annual allowance tax charge for some NHS pension practitioners. It was a sort of offer born out of GPs who were refusing to do extra shifts because actually they worked out that they were getting taxed at additional rate income tax. They were over their lifetime allowance. They were getting taxed on their pension contribution. They were having already over their annual allowance, so they were getting taxed on that, and they were actually refusing shifts because they realized they were seeing about 35p in the pound for the work they were doing. Not all over, but it was causing problems. So they offered for a particular tax year to pay the annual allowance tax charge. We've all arranged that for a number of clients through Scheme Pays for the 1920 tax year. So it will be similar to that, where there's this remedy, there will be a similar offer for that type of thing. As I say, I don't think this will affect that many people, but you should definitely have a look with me or another financial professional when you have those figures come back to you, to make sure that that's not the case, or there's any other opportunities because you've got other allowances available. Lifetime allowance, in terms of how that affects you, well, as you can see, the schemes accrue in completely different ways, and it will affect your lifetime allowance. If you've retired in between, then the different types of schemes have different retirement ages. They accrue in different ways. If you're suddenly moved back from a 2015 scheme into the 95 scheme and you've taken your pension, then your lifetime allowance may look, in terms of usage from the NHS, may look different, and that may have affected what you do on your personal pension planning. So we have to look at that carefully. I think if you remember, a lot of the members who've retired, not all, but a lot who've retired in between, will have been either fully protected members, so they never joined that 2015 scheme in the first place, or transitional members where they may have only been in the 2015 scheme for a short period of time. So it probably isn't going to have a huge effect for most people, but some who've retired early, 56, taken their pension early, that they might have actually, been in the 2015 scheme for a few years. It might have had quite a big effect. So again, you'll be given these figures when ready from the NHS by October 2023, we hope. You can speak to me or another financial advisor. We can look at your situation and work out how it affects you. And any remedy to tax charges, anyone who's taken their pension can see how complicated it is with lifetime allowance tax charges and how they're calculated and how it's deducted. It's all done by them. As I say, anyone who's taken their pension and can see with an IFA how it works in terms of the nitty-gritty of the deductions and how it affects your income will know that these changes that are coming into place are going to be a big headache for the NHS to sort of quantify. So that's why they needed, took a couple of years to actually get their heads around it and get all the figures together. So we will help with that when you have those figures available. So with all this in mind, what are the key things to consider? Which scheme is best for you? We've touched upon the fact that it's likely for a lot of members, especially those who are planning to retire at age 60 or 65, so before that age 67 for the 2015 scheme, it's likely for a lot of members it's going to be better to have moved back into the legacy scheme. That's why these firefighters and judges have fought tooth and nail to have this overturned, because that scheme, in theory, if you want to retire at those ages, is better, the legacy schemes, because you don't have to wait till you're 67. So it's likely quite a few of you will be better having moved back and kind of carrying on as usual and just working out the annual allowance and the lifetime allowance tax charge implications, but not always. And if you consider somebody who's carrying on working past age 60 up to 65, 66, they were in the 95 scheme and they didn't have that much additional benefit. They might not have that much additional benefit in between in terms of the growth. If they're working on past their normal retirement age, that's something to consider. They might be better off having been in the 2015 scheme. If they've got a specific situation of their pay, which is irregular, it might work out that actually they'd be better off. So there are not always clear-cut options and answers for you as members. Everybody is unique in terms of their situation, and it's not just their working situation, their own tax situation, their own retirement situation. So you'll have to have a look at the data when it comes through. The NHS will help with this by sending through information and guidance, but it's going to be a lot of data, and you can show it to myself or another financial professional if you've got an IFA, and they should be able to help. You should pick an IFA if you're not dealing with myself that is au fait with the NHS pension. I spoke about some of the options at the start. It is a few things that you can use to your advantage. So you should make sure that whoever you speak to does know about the scheme. So which scheme is best for you will depend on your situation. If you're looking at how the annual allowance figures change and whether there's a tax charge or a refund, I hope I've kind of answered that a little bit today. The devil will be in the detail in terms of the figures when they come through. You have a list of your annual allowance usage in those 7 years from what you had already compared to the remedy, which is moving everything back to your legacy scheme. How has that affected you? You look with your IFA at what other pension planning you've done, what allowances you've used. There's going to be a lot of sort of going back over data from 8 to 10 years ago and going through the allowances, but it's necessary to work out where you are. And if there's anything that needs to be done, you can change it. Scheme pays, you will be able to change your election retrospectively if you've already done scheme pays and it's been deducted from your pension. Scheme pays, for anybody who doesn't know, is if you have an annual allowance tax charge, so you're over your annual pension allowance in the year because of the NHS pension growth, basically, then you can ask the NHS pension to pay the tax charge that's due on that. If you go over your annual allowance for any pension savings, there's a tax charge. You basically pay back the tax relief that you've received. If you get 40% tax relief on that going into the pension, you pay back 40% of the excess over your annual allowance. And scheme pays is where the NHS pension pay that. And then if they're paying it for you and it's a few years to retirement, they charge you a bit of interest in between. There is talk of if there's been a difference in the scheme pays election and they've charged you interest in between, then they're going to remedy that as well. So they'll effectively make sure it's absolutely fair and square, and probably even more so with the scheme pays election. So don't be concerned about that. If you have used scheme pays, it will be made good. We've just got to sit tight and wait for the figures to come through. How long do you have to change your previous tax returns and scheme pays elections? You'll be given good time. And of course, you can imagine we're not going to suddenly have 3 million public sector pension members all having their data on the same day. It will probably be drip fed, and you'd hope that they'd look at the people who've already retired first and then look at the people who are near to retirement, sort of in age. Will that be classed as age discrimination? Probably, I don't know. But basically they'll be doing it in some sort of order. So we'll have it drip fed through and you will be given good time. But once it's through, you should speak to your tax advisor, your financial advisor, and start looking at that straight away, just to make sure that there's plenty of time to do it. It's all going to be done retrospectively. So really, there's not a current tax year deadline you have to operate to. You're going to be given good time. But in terms of announcements on the exact time scale, they're not there yet. You'd hope that by the time they send out the data, there will be some sort of structure to exactly how long you have, and then we can relay that to you. Obviously, any updates in between, I'll let you know. At the bottom, I've noted, do these changes impact on your personal pension planning? Well, yes, they do, more so for some clients than others. If you've got an enormous NHS pension that's over your lifetime allowance and you can't actually do any personal pension planning because you're over the lifetime allowance, or you're going to be comfortably, then of course you just have to look at these changes, look at the data when it comes out, make a decision on what you're going to do and what suits you best, and go with it. And if you've taken your pension in between, have that all remedied. But for a lot of our clients, some of those who I'm sure are here today, your NHS pension might be very valuable, but it's not up to that £1 million or 1.073 million, which the lifetime allowance is. And actually that means that there's massive benefit in adding to a personal pension. Going back and making changes to your NHS pension may actually give you more scope to do personal pension planning. It may give you more annual allowances to make use of through carry forward, for example. So it may well have an impact on your personal pension planning, and of course your retirement planning. You might have had your head around exactly what your NHS pension was going to give you, and suddenly that may change because 7 years worth, it might be completely different to how you expected. Now, that's something which you need to look at. And if you're not about to retire anytime soon, the NHS pension planning can wait. But in terms of personal pension planning, if you have scope within the lifetime allowance, you might want to look at this sooner rather than later. So we'll talk about that later in this webinar. Just do a quick time check. Okay. I'll rattle through a little bit now because I'm sure I'm waffling on a bit. Now, in terms of how we can help you, we provide an NHS pension assessment report. A lot of the clients that we deal with already who are logged in to watch us today will have had some help from me on their NHS pension in the past. And you do need to download, if you haven't done so already, your total reward statement and pass that to a financial professional to look at. But in terms of forecasting, not just what you have now, which is what the total reward statement will show you, but how is that going to grow to retirement? What can you expect to get at retirement and how it will work for you at retirement? This is where hopefully our NHS pension assessment report will be very useful. So we can assess your current NHS pension benefits, give you information on the scheme structures like we've done today, but specifically for you, and again, considering what will happen from the McCloud Judgment in terms of your specific situation. Information on the retirement options, again, we touched upon those today, but in terms of your specific situation, what you should potentially look at. We can compare the two options for the scheme benefits for you, and we can start looking at that now, because if we know how much you've been earning in the last 7 years when you're likely to retire, we can do a pretty accurate, reasonably accurate projection of the different benefits that you may have accrued in the meantime with our calculators. We would have to wait until that exact data comes back to us from the NHS to redo the comparison. But in the meantime, if you're thinking, well, I'm going to retire or I want to maybe retire in a couple of years, I want to look at this now, I can't wait until October 2023, then by all means, we can do this comparison. We'll look at annual allowance assessment, lifetime allowance assessment, your scheme pays option if you're over the annual allowance, and then other pension planning opportunities. Now, we'll be charging a fee for these pension assessment reports. We'll give a sizable reduction to existing clients. Formalize this process a bit more considering the McCloud Judgment, because there's a lot of work to do it. And if you're interested in these reports, let us know and we'll provide further information about those for you and happily help where needed. So is this a good time with the McCloud Judgment to review your financial planning? The NHS pension for any client, especially if you're a dentist, as a lot of you are here today, with a business, isn't the be all and end all of your financial planning. You need to be looking at other areas, and you need to be asking questions like, are you optimizing your personal pension allowances? You want to get as close as possible, if affordable, to the lifetime allowances. Personal pensions with the tax reliefs they offer are extremely beneficial. They're much more flexible than the NHS pension in terms of how you can access them. If you already have a personal pension, how is it working for you? Do you know how it's going to work for you in retirement? Is it growing properly? Is it being managed properly by your existing IFA? Or if you're managing it yourself, how's it performing? And in terms of your retirement planning, are you prepared? Do you know how much you're going to get? That ties in very neatly with the McCloud Judgment. Do you know what your NHS pension will be? But do you know, apart from the NHS pension, what you're going to get from your business, from your other savings? What income can you expect to take in retirement? Have you saved enough? So obviously, in terms of saving, if you have spare income, and especially when your known expenditure for things like children or your business set up are out the way, if you're in your mid-40s, late 40s, early 50s, savings should be in the forefront of your mind. And are you saving enough to grow your wealth? Do you have enough saved outside of your pensions and things like ISAs? And has your partner saved too? You don't want to have a lopsided arrangement where all the money's in your name, or you've got a big pension and your spouse or your partner hasn't got as much savings. Everybody has an individual tax allowance in the UK. You want to make use of them in retirement. Tax planning, potentially a good time to review, especially for those, as I say, who are approaching an age where they're planning their retirement or exit. Are you using your tax reliefs available? If your pension's over the lifetime allowance, how can you remedy that? There's some clever ideas to actually plan for that. So any of these areas we can help you with. If that's of interest, of course, let me know. I've given an example here for those who aren't saving outside of their NHS pension, or those who are, just to get an idea of how savings can work, of how beneficial it can be to add and to supplement aside from your NHS pension. I've got an example here of a lady who's a high rate taxpayer, has actually cut down her NHS work. This is very typical of a lot of our clients. And she doesn't have big NHS pension contributions anymore. So actually, with that £30,000 a year that she can afford to save away for the next 18 years until retirement age 65, if she put, for example, 15,000 net into a pension and 15,000 net into an ISA, how would it grow? You can see from the projections there that she could have 664,000 in a personal pension by age 65, and should be able to comfortably take 40,000 a year. I mean, you could probably take a lot more than that. That's been quite moderate with growth figures in terms of retirement, but certainly should be achievable and inflation linked. And in terms of an ISA, which is tax-free growth, no tax reliefs like on a pension, but tax-free growth, you should put 15,000 a year in for 18 years, you'd have 400,000. And the difference between the two is the pension gets the tax reliefs added on. So it always adds up a little bit quicker than an ISA. Pension should always be looked at first before an ISA, especially if you're within sort of 10, 15 years of retirement. As I mentioned there, don't forget about your spouse's pension and ISA savings. Don't lopside your savings. Don't have it all in your name. Make sure it's equalized where possible, and speak to a financial professional to make sure it's being done properly. So just to finish up, key takeaways from today. You'll be given a choice. When we have all the data from the NHS, you will be given that choice, and you'll be able to make a choice between the legacy scheme or the 2015 scheme for that remedy period between 2015 and 2022. In the meantime, you're going to be treated as everybody going back into the legacy schemes. They have until October 2023, the NHS, to implement this and confirm all the figures. From April 2022, everybody's going to be in the new 2015 scheme. Those who are still active members working, you'll be in from that date. You'll have everything else in between move back to the old legacy scheme, but you'll definitely be in from that date. As I say, your legacy scheme's protected. It doesn't go anywhere. It's still inflation linked. And importantly, there's some technical details yet to be finalized, which is a little bit of an understatement, but they have made good traction this year in terms of these announcements and what they're going to do since they announced that deferred choice underpin. So I'm sure there'll be other updates coming out soon. Planning, we've already mentioned that you have to retrospectively assess your tax position, the annual allowance, the scheme pays elections, and whether this has affected your retirement plans. Those of you who aren't clients, feel free to contact me and we'll have a chat on the phone. We offer a free, no obligation consultation, and we can look at your situation, your NHS pension, your other financial planning situation, and happy to help. Chris, I think I'm done now. So if I bring you back in, I'm going to go into the Q&A. If anyone else has any questions, there's a couple in here I'm going to answer now.
That was brilliant, Adam. Thank you for that.
Thank you, Chris.
I don't know whether 98, 75, 2015, whatever schemes they are, but flip, it's complicated, isn't it?
Lots of figures, but obviously you can rewatch this webinar. I'm here to answer questions if you need it. We'll send you a copy. There's lots of guidance on the NHS website. And obviously, as things are announced, we can release announcements on these, Chris. So if anyone else has any questions, please fire away and type them. So in terms of the first question, someone's asked, will the slides be available for future reference? Yes, absolutely. Everybody who's been on the webinar today will automatically send a copy of the webinar, and we can send a copy of the slides if you don't want to have to sit there and listen to me again, just to read through, because a lot of the important information is in the slides. So we'll do that for you absolutely fine. If you know anybody who says, oh, actually, I'd like that of interest as well, they can contact us with their email information. We can send them these slides, but also importantly, the other updates we have on the scheme when they come out. And we've had a question from Ivy, who has asked, what can you do if you're on the 97, 2008 and 2015 schemes? Thank you. Right. So in terms of the schemes, you should most likely, unless you've changed jobs, I would imagine that you're actually in either the 95 scheme or the 2008 scheme only. I'll come back to you, Ivy, separately to look at your situation. But as I mentioned, it's likely a lot of you today will have multiple schemes, and each multiple scheme will operate in a different way. You'll have a different retirement age, you'll have a different way that it accrues, and they kind of operate in unison, but you're only ever contributing to one scheme at a time. So you're not adding to all these schemes at the same time, and they're all sort of going up in different ways and mucking around together. You will have one scheme that you're the active member of. So as we said, that's going to be moved back to the legacy schemes between 2015 and 2022 for everybody. And from April 22, so April next year, everybody's in the new scheme for their new benefits. The other schemes are protected, inflation linked, they're still there. They still have the same rules in terms of accessing them. And when you get there to access them, you have flexibility to take them at different times if that should suit your situation. That's really important. If there's no other questions for today, I think we'll leave it there. Thank you, everybody, for attending, and I hope to speak to a few of you soon.
Yeah, thank you very much for, as Adam says, thank you for all listening on a, what is it, a Thursday? Is it a Thursday or Wednesday evening?
Wednesday.
And, oh dear, this week. And thank you very much, Adam. That's very useful. As Adam says, we'll send you a copy of the slides and the webinar recording, but it'll probably be in the next few days or so. But once again, thank you very much, everybody. And I'll, if there's no more questions, then I will end the meeting for us all. Can I go have a cup of tea?
Wonderful. Thanks, Chris.
All right,
see you soon,
thanks,
everyone.
Adam. Cheers, guys.
Bye-bye.
Bye-bye.